pre-approve, how to pre-qualify clients without a lender. Why? Is because a lot of times lenders pre-qualify clients for bank approval, but it doesn't mean it's going to be approved by a certain property. For example, co-op, some condos, and even the house. If your seller is very particular who they want to sell it to, you want to make sure that the client is qualified to purchase. Now, you look at two different debt-income ratios, front ratio and back ratio. Who could tell me what front ratio is? Come on, you guys, wake up. Let's do it together. What does front ratio will represent for you guys? Anybody? Okay, front ratio is your future housing, total future housing divided into your total income. Back ratio is total new housing plus all other debt like car lease, car loan, student loan, child support, maintenance, and any other credit card minimum payment, and any other obligations, monthly obligations, except electrical, cell phone, and food, and etc. So that's called back ratio. Co-op and banks, most are looking for back ratio. We call it total debt to income ratio. Now, let's do some exercise. In order to get total debt to income ratio, first we have to find out front ratio. So let's just do, for example, the purchase price is $500,000.
Can you guys see that? Are you writing anything, Olga?
Yes. Can you see it?
I can't see it.
Oh, you cannot
I
see
can.
it.
Blank.
Okay, let me do this red.
There is a light hitting right in front of the.
Okay, no worry. Woo. Why don't you guys take a piece of paper and write it with me? So this way you could see it from your paper and I could see it from my paper, my board, okay? So we're gonna say a purchase price, 500,000. Can you see that? Oops.
Jen, can you grab us a new marker?
No, you
Nice.
cannot see it.
Fresh marker
It's okay.
for Olga, please.
No dice.
They put $500,000 purchase price. The down payment will be $100,000. So your new loan, your loan will be $400,000. Now, if you guys have a smartphone, download the program called Carl's Mortgage Calculator. So if you put down in there 500,000 and 20% down, it will come up that your new loan is 400,000. Let's say, for argument's sake, the interest rate is 6%. Then your monthly total. So if you use this cost calculator, you don't need a piece of paper, you don't need to calculate, you just kind of put numbers in there. So you're gonna put on 500,000 purchase price. Does everybody has Carl's mortgage calculator on their phone downloaded? Yes? Okay, so then we have 400,000 at 6%. You're gonna put on 30 years for the terms. So then it gives you a monthly payment, $2,398.20. Now, if you scroll a little bit higher on mortgage calculator, it has monthly HOA, monthly expenses, annual insurance, annual taxes. So let's assume you're buying one family house and the taxes is $12,000 and insurance is $1,800. So it calculates monthly expense, insurance and taxes, $1,150.
How much did you put for insurance?
1,800.
1,800 and
Yep.
HOA?
No HOA, it's a house,
House, okay. And taxes?
12,000.
Okay.
So your total is 35, 48, 20. Let's assume a person makes $80,000 a year. So you're gonna take $80,000, divide by 12, you're gonna get $6,666.66. Now, in order for us to calculate loan ratio, we're gonna take a housing expense, which is 4820, and we're gonna divide by 6,666. So we're gonna do 35, 48, 20, divide by 6,666, 66. So it comes out to 53%. Is this borrower qualified to buy a $500,000 house?
Negative. DTI is too high.
DTI is too high. We're not even adding all other expenses. So this is how quickly you could identify. I get a lot of calls from realtors saying, oh, can you pre-approve my client? And the client absolutely not even close to buying it. So realtors wasted their time showing the properties, and on top of it, they're not even mortgageable. If they buy a co-op, they're not even mortgageable for any property. So let's assume they're making 180,000. So you're gonna take 100,000, divide by 12. Now they're making 15,000. So if you're gonna take 35, 48, 20, divide into 15,000, your debt to income ratio is 23%. That's a housing debt to income ratio. Now, that person will be able to buy a house.
Yep. Oh, yeah.
Let's take a look if they have any other debt, because that doesn't 100% give you an answer because you don't know what other debt they have. So you're going to ask, do you have any student loans? Now, be careful with student loans. I have a client who's buying a co-op and they have a student loan of $300,000. She's an attorney, is deferred until 2027. For the bank, if it's deferred, depending on what program she's getting, we still have to pick up sort of debt. The same thing for co-op, right? So for the bank, if the student loan is deferred, and the Fannie Mae program, we have to pick up 1% of outstanding debt. So she has 300,000. Now I'm going to add all the debt the person has. So $3,000 potential debt. She has a car lease for $1,800. And she has minimum credit card payment about $750. So now let's take a look. We're going to add 35, 48, 20. We're going to add $3,000 plus 1,800 plus 750. Now her total debt is $9,098.20. Now we're going to divide $9,098.20 into 15,000. Her debt to income ratio is 60%. Can she buy the house? Hello?
Well, you didn't let us know what the,
No, the DTI is too high, so it's gotta be,
yeah, what is?
Okay.
50%, is it?
For most of the programs, for Fannie Mae, you could push the envelope to 49%, but the best is 45%. Now, if you want to go above 45%, you need compensating factor for the bank. What is compensating factor? Well, the client has a little bit tight on the debt income ratio, but they have a 6 months post-closing reserves. They have stable job.
What is that term called? Compensating
Factors. They have stable job, they have 6 months post-closing reserves. We could use for the bank, we could use any retirement account, 401k, 70%. They have very good credit, very good credit score, never late, no collection. So if that kind of compensating factors there, we could push the envelope to 49%. If we ran through automatic approval, and it gives us approval. But for your sake, keep it at 45% for the house and the condo. If it's more, then it's a little bit risky. Just take a look if they have compensating factors. 60% is absolutely high. Even though you think, oh wow, the client makes so much money. So where my client realtors made a mistake. She said that, oh, I'm making $280,000 a year. And it's guaranteed income. She forgot to tell them that they have $300,000 outstanding student loans. She did tell them about $1,800 car lease and $750 credit card debt. So when we got the loan, she was not making $250,000. She's self-employed. She makes $250,000 on K1, but the previous year she made $50,000 in 2023 and $150,000 in 2024. 2025 she will make $250,000, but it's not reported yet. So if you're not W-2 income earner, the banks will use last 2 years on a tax return. They're not going to use 2025 if you didn't file. Very, very important. Even if it's guaranteed income, if you're self-employed, it has to be filed with the IRS in order for the bank to use it. So now she signed a contract with 45 days mortgage contingency, and unfortunately, she's not qualified. We have to wait until February 15th. She files a tax return. She physically has to file. We have to get a receipt, and then we could average 2025 with 2024, and that's income we could use. So it's not going to be 250. It's going to be 250 plus 150 divided by 24. So it gets very complicated, even though the formula is so easy. Total debt divided into total monthly income will give you that income ratio. But in order to know total debt, you have to ask a lot of personal questions. One of the questions is very sensitive. Do you have child support? So I have another client buying a house. His child support is $1,800 a month. He forgot to mention that to the realtor, and he said, yeah, but I pay her, we don't have agreement, but I pay her every single month. So when the bank reviews the bank statement and see $1,800 coming out every single month, they will question it. Or sometimes people don't put it in, they pay cash, but it's only a divorce decree that they have to pay. So the bank does check it, or sometimes it's on the pay stub that they pay child support. And a lot of time employer don't put down child support as a description. They code it because, you know, for certain requirements, they code it. And when you have to ask the code, then you find out they have to pay child support. So let's dig in first how to figure out total debt. We got the picture, right? The easy formula. Total debt divided into total income. Now, how do we figure out total debt? First, we're going to figure out monthly future payment of the properties they buy. So on this particular case, we know it's $3,048.20. You all with me, correct? It's $500,000 purchase price, $100,000 down, $400,000 loan at 6% will give you $23,9820. Your monthly carry cost for insurance and taxes $1,150. So your total future housing debt is $35,4820. Now let's figure out total debt. Sometimes you will not see credit report, but it would be helpful if you ask for copy of credit report from, you could get it from any credit bureaus, or the best one will be creditkarma.com. Why I love creditkarma.com, it's free. It gives you 3 credit bureaus together, gives you 3 credit scores, and it's very detailed report. From creditkarma.com, it also gives you summary. It tells you what expenses you have. So you're going to see the expenses such as mortgage, if they have a mortgage. You could see if they have student loan, revolving credit. You're going to see that on a credit report. Now, what you're not going to see on a credit report? You're not going to see on a credit report child support, maintenance. You're not going to see on a credit report if they have a property that has no mortgage. You're not going to see that other debt on the credit report. So those are questions you're going to ask.
Olga, question, I don't know if it's fully related, but we had a situation where we didn't know that they had an SBA loan.
Yes, SBA loan is part of your business. And when you take the business income, it's already subtracted from your business expenses.
Okay.
You don't have to hit it twice.
So it wouldn't count as a negative towards your DTI?
If you're going to use a net income, it's already deducted. So you don't have to deduct it second time.
Okay.
Even if it's on your credit report, you see SBA loan, that means they have a business. Ask for the business tax return. Because if it's already deducted, you don't need to hit it twice.
Okay.
But if the business dissolved and they still have to pay SBA loan, then you have to hit it.
Got it.
Olga,
Yes.
just to add on to what Vincent was saying. So then if they are an independent worker and they are self-employed, do they need 1 year of tax returns or do they need 2 years of tax returns to be qualified?
It's a great question because some programs will allow you 1 year, some programs will allow you 2 years. Now, it depends which program you're going to go with. If you're going to go to SUNYMA, they will ask you for 3 years. They're going to average the income last 2 years, but they want to see 30-year tax return. If you're going to apply for FHA loan, 2 years. If you're going to approve for Fannie Mae loan, if your business in existence for 5 years, and GU, which is desktop underwriter, will come back asking only for 1 year, you could qualify with 1 year. Freddie Mac is a little bit more flexible. Less than 5 years, and again, it's called LP. So Freddie Mac is LP. Fannie Mae is GU. If LP comes back with 1 year tax return, you only have to give 1 year tax return. So that's why it's a little bit tricky. But the longer the business in existence, the more chances for you to get 1 year tax return. But if you're only 2 years in the business, you most likely would need 2 years because all the GU and LP are looking for stability and they're looking for how long you've been running the business.
What percentage of pre-approvals would you say are incorrect?
Well, it depends. I honestly think it's not the bank. It's a person working for the bank. So I see a lot of loan officers want to cut. It's a lot of work to get you pre-approved. Because you have to look at tax returns or W-2s, pay stub, bank statement, and even bank statement, you have to identify if any flags are. So sometimes people will call, just give me pre-approval, I want to see the property, and they don't let me in without pre-approval. Even one officer is not, what's the word I'm looking for? Thorough, or they just want to get you off the path and please agent, they will issue you pre-approval, but that pre-approval means nothing. You as an agent, your due diligence is to make sure any pre-approval you get, you can double check and identify any yellow flags, because your income is tied in to that borrower, to that person who wants to buy. Even bank made a mistake or they didn't do their due diligence, they just, as per your request or as per laziness, issue pre-approval, and you did not identify there's an issue, you're putting yourself in a position to work for free for 3 months or 2 months or even longer. And not only you're not going to get paid, you're going to get very frustrated buyer, who's going to be very upset that they did not cross the finishing line. What the questions you need to ask, besides looking on a credit report and get your monthly debt, you need to ask, do you have a child support? Very, very important. Now, you would think that you should only ask of child support on male. Females pay child support as well. You gotta ask for both. Listen, we fight it for being equal, and being equal, sometimes women pay child support. You have to pay maintenance fee. The maintenance is, again, you would ask for both. And the way I ask those questions is, I would say, oh, I see you have total debt. I just want to make sure we pick up all expenses so we don't have any issues in the future. Do you have to pay any child support, maintenance? Do you by any chance on any other properties that has no mortgage that we're not going to see it on the credit report? A lot of times they co-sign on a property and not paid on the mortgage, or we see where parents put their children on the deed and the mortgage is paid off. We still have to pick up expenses of that property. As if the payment are made from joint account. If a payment are made, let's say parents put the child under the deed and they're making the payment, you would have to give a proof that parents made a payment for taxes and insurance. Now, we see a lot of times on the credit report, there is a mortgage. I said, oh, I just go sign it for my mother. I don't live there, or I live there, I'm gonna move. So if you co-sign it, and the mother paying the mortgage out of their account, total debt will be eliminated. For 1 year, they have to give a proof that they paid it. If they didn't pay from a separate account, they paid from joint account. And the argument was, well, I put more money in a joint account, so it should consider
之
that
前
I
出
make
价
a
没有
payment.
买到吗？
And
你
unfortunately,
出
no.
多少？
If a payment goes out of joint account, your debt will be calculated part of other expenses. Now, student loan. A lot of parents co-sign student loan for children. They comes up on their credit report, but they don't make payment. They're not deferred. They have a monthly payment. So then you're gonna say, well, who makes the payment? And I said, oh, my child makes the payment. If it's less than 12 months, it's your debt. If it's more than 12 months, a child made the payment, that payment will be subtracted from your debt. Car lease. I co-sign car lease for my brother, but he making the payment. As long as we can show the payment made by 12 months by my brother, that debt will be subtracted. Call is for 1,800. If the shows the payment is made from a business account, that could be subtracted. So you gotta really dig in order to find out total debt. It sounds easy, but if you don't ask all the questions and get a lot of paperwork, then you could disqualify a client that might qualify or vice versa.
And a lot of times, the buyer might feel more comfortable with you than they do with the loan officer. They might tell you more.
Correct. Sometimes they tell you too much and you really don't want to know, but it will help you to identify their total debt. So what else? Child support, maintenance, deed, expenses. So let's see, this is for the house, right? But let's say if you're buying a car, not only all this plays in, you have to take a look at the tax return, because management will look at the tax return to see how many people on your tax return. So if you buy one co-op, one bedroom, and you have husband and wife and 3 dependents, will it be a red flag? Hello?
Say that again, I'm sorry.
So if you're gonna take a look at a tax return, right? And on a tax return, you have husband, wife, and 3 dependents, and they buy 1-bedroom apartment. Is it a red flag for the co-op?
It is.
It's not a red flag for the bank. We will issue you a pre-approval. Now, I check it because I don't want to waste my time, and I will let the client know and the agent know, oh, wow, if they buy a 1-bedroom, but they have too many people, you're not going to get a board approval. A lot of times I get a response, oh, my parents live overseas. I just put them on a tax return. Now, bank doesn't care how many people in a tax return, because we go by income, by debt to income ratio, but co-op does. And if the parents live overseas, then why are they doing it in your tax return? So we had a lot of people amend their tax return but then the question will be, oh, I don't want to pay extra taxes. Well, you gotta be careful what property you buy and what you're gonna issue on a tax return. So those are key things that you as a realtor will pick it up, while loan officer doesn't need to pick it up, because we still gonna give you the loan. You see the difference? Now, a lot of times people say, well, I have a pre-approval and I'm taking a client to buy a co-op, which is cost $750,000. Am I okay to show property without going through myself with all the paperwork? You should, because a bank will give you pre-approval based on 45% DTI. But most of the co-op need 28 to 30. The more luxury apartments, they're a little bit more stricter than buildings that is a little bit more loose. But majority co-ops, they want to stick between 25 to 30%. So even though you have a pre-approval, your job is to do your own work so you don't lose time and effort and client's time and effort. Because client not only losing time, they're losing money. Why money? Is because in order for them to get the client by the co-op, they have to pay for appraisal. They probably have to pay half of the legal fees. They have to pay at least $1,500 co-op fees. So you're looking at about $200 to $2,500 expenses if you don't catch it in advance. So they become, go ahead.
I got a question on since you're talking about with the debt. Okay, I get that with the 45%, but let's role play. Let's say with me, I have a second home, but I'm looking for a primary home. I have a rental income. Can you add that to my income of 100% or like 75% to that?
Okay.
So I can lower my DTI.
Excellent question. So we finish with that. Let's take a look at the income. That's an awesome question. If you have a second property, right? Now, the question will be, how long do you have this property, Chris?
Oh, okay. I've had the property since 6 years.
6 years. Have you rented before?
Have I used it for rent? Yes.
Excellent. If you rented before, what we're gonna use is your last tax return net income plus. If you have the mortgage, we're gonna add back the interest. We're gonna add back on your tax return, taxes and insurance and depreciation. Because that's gonna be your base income. Then we're gonna subtract the mortgage
Okay.
from the base income and determine how much income can we use.
Okay.
It's a little bit complicated formula. Why? Is because when you tax return, a lot of people write off a lot of debt. They write off repairs, 100 different things, supplies. Now, that's going to be reducing your debt. I mean, that's going to reduce your income. Because what we're going to do is we're going to take a look at the tax return and say, okay, you made negative 5,000. We're going to add back the interest. We're going to add back the taxes. And if it's, let's say if it's a condo, we're going to add back HOA. And we're going to add back depreciation. So then you're going to have your base income. We're going to subtract principal. Then it's going to be, it's your sub-base income, that's going to be your base income. That base income, we're going to put it in, and then we're going to hit the mortgage, because mortgage is going to have interest, principal, taxes, and insurance. And if you have HOA. So it's not it's not the percentage if you own the property for 6 years and you rent it. But let's assume you're living in a house and now you want to upgrade, right? So you don't want to sell your house, you want to rent your house. Then you take 75%.
Oh, okay. Got it.
Across all the programs. SONIMA, FHA, Fannie Mae, Freddie Mac, every portfolio, everybody takes 75%. Why? It's because 25% will be for vacancy.
Okay.
Now, Chris, I assume you're self-employed, right?
Yes. Yes.
Excellent. How do we calculate your income?
How do they calculate my income?
Yes.
Oh, well, after they minus the deductions and the expenses, and then my gross income came into play with it. I mean, I have a couple of things lined up, but it was complicated. But yeah, so it was a lot of my income was just based on deduction, and then my gross came at the end of it. I hope I answered your question.
Gross adjustable income. It's not just the gross, it's gross adjustable income. It's your gross income minus all your expenses. That will equal to gross adjustable income. But before you pay health insurance and contribution to your IRAs. Now, as a self-employed, you have different avenues how you can get the income. You have Schedule C, you have K1s, you have so Schedule C, you have corporation, and you have let's say for example you have real estate income. So each of that income, real estate income, we're going to take the most current tax return. Schedule C, the average last 2 years. Again, if you will allow us to do 1 year, we'll just take 1 year. And the same thing with K1s. If the income current, let's say 2025, you did your tax return and your 2025 is higher than 2024, and you need 2 years tax return, we average 2 years. However, if 2025 is less than 2024, we take the lower number.
Mm.
We don't average, we take the current income of that year. So most important, the current income, if more, we average. If less, we take the most current income of the tax return, not what they're gonna earn. That's the biggest skill. Because a lot of times when you ask a self-employed person, how much you made? A lot of people will give you gross. Oh, I make 350,000. And the most important question you have to ask, if it's a gross or a gross adjustable income. Because in their mind, they're making 300,000. They're not netting 300,000. The next question is, this year versus last year, how did you do? Oh, I did much better. Or they're gonna say, listen, this year was not as good, but I still made 300,000. So you have to ask questions in order for them to give you the right answer. Because a lot of times they're down to the send you the tax return. So what we do is we're gonna say, listen, I wanna scrutinize your tax return because what you think you made, it might be different from what the bank thinks you made. Sometimes they think they made less because we could add back the depreciation. We could see and we could massage the numbers, sort of say, to see what a real number we could take. It gets complicated when a person makes W-2, K-1s, Schedule E income, which is your real estate income or your business income. Those you have to treat differently for each category of income you make. W-2 income, even though we look at the last 2 years, we take the most current income they make. We don't average as long as it's not overtime, commission, tips. If it's a regular straight base income, we take the most current income. So if they got a raise for $10,000, we're gonna go based on the new income. On K1, we average the income. On Schedule E, we take a look and we in order for us to identify the true income, we must get a copy of a mortgage statement. If there is no mortgage, then it's easier. But if there is a mortgage, we have to, why do we get a mortgage statement? In order to see how much your principal is paid every single month, because that gets added back in. If you own the property for 6 years, and Chris, let's say you own the property for 6 years and you never rented. Now you want to buy another house and you never lived in that house. It's your second home, you never lived there, or you rented but did not report in your tax return. You cannot use that income.
Got it.
Overtime, bonus, commission, tips, any other income other than your base income have to be averaged last 2 years, as long as current year is the same or more. If a current year is less, you do not average. You still have to look at 2 years. If there is no income for 2 years, you really cannot use that income. So let's say a person switched from a base salary to commission, and they only work a year as a commission employee. We cannot use only commission because we don't know average of last 2 years. Let's say a client switch from base salary to hourly. We have to wait for 6 months in order to know how much average hourly income will they make. So let's say they switch from base salary to hourly with overtime. And they only made overtime for 4 months. We cannot use the overtime income. So in order, you see, as complicated as expenses are, income gets more complicated because there's so many components that makes up the income. I have a lot of people right now buying a co-op and selling their houses because they want to downsize. Well, they're no longer making the income, but they get Social Security, they get pension, they get annuity. We look at that as an income or disability. That is income. But the way we look at that income is a little bit different than the way we looked at W-2 income or self-employed income. When you look at the tax return, right, and the Social Security income, you have one box showing, let's say, 36,000. But on the income section, you show much lower number. We take a look of how much income on the Social Security page. If it says 2850 before the taxes, we take 2850. Even though on this section of tax return, where you show how much income they make, it's less. We still pick up the higher income. On the pension, we pick up the pension income. A lot of times pension, they ask voluntarily deduction on the federal expenses. We have to add that back because we pick up gross. Then you have disability income. Disability income, we just want to make sure that you have ability to receive that income another 3 years. Because if disability income ends, that means we cannot use that income. Annuity. Annuity, we also want to see if you're going to get it in the next 3 years. There's other income we could use, sell of the business. If you have a business that you sold, you're going to be receiving part of your sell agreement. For the next 5 years, you're going to receive the payout. We're going to review that agreement, and we're going to use that income of your payout. So you see how complicated it gets? So sometimes pre-approval is vanilla. It's a simple, easy vanilla ice cream. Sometimes approval is your vanilla with chocolate and lots of different add-ons. And if you don't know how to use those add-ons, you're going to get yourself in trouble. So you have to educate yourself a lot more than a regular real estate agent to be above and beyond. Because if you're going to catch a mistake in the beginning and you're going to save a lot of time, it's never your time. It's always your client's time and client's money. They're going to be much loyal to you than any other agent who just shows apartments or houses or condos. Any questions before we move on to? I know it's too complicated. I know for me it's easy. I live and breathe. I do this.
I want everybody to really understand the simple version of
Debt income ratio.
of debt to income ratio and generally pre-approving a buyer within the
Scope of easiness.
the 45%.
Yes.
I want you guys to be able to sit down with the buyer and say, okay, here's what your income is, here's the expenses, right? And here's the general credit score that you know you have, and then figure out, with how much assets they have, if they're qualified for the
Goodbye. Excellent. So we're going to learn that right now. But if you get a complicated one, what Maria does a lot of times, she says, Olga, I'm sitting with a little bit complicated file. Can you walk me through it? With authorization from a client, she emails to me and we do it together. So as you do complicated 1, 2, 3, 4, you get a lot more educated because it's very hard to get, easy ones, it's easy, but it's hard to get a hard one right away. So let's do the easy W-2 income. Let's say they made $135,000 in 2024, 138,000 in 2025, and 150,000 the income they got the raise, and that's gonna be in 2026. Tell me how many different ways of people going to get paid as a W-2 income? Weekly,
Weekly, bi-weekly, or semi-monthly.
very good. Weekly, bi-weekly, semi-monthly. Sometimes, very rarely, I see monthly. Very, very rarely. Okay? How do you convert weekly into monthly payment?
You have to multiply
Yeah,
your weekly by times 4.
Why 4?
4, because as you said, go into monthly, right? So there's 4 weeks in a month.
Excellent. But what happens when there is 5 weeks in the month?
Interesting.
It should be. Sorry, I think it should be by 22, by 52, sorry, 52 weeks in the year, and then divided by 12. Isn't it like that to get the monthly?
Yep, you're going to multiply by 52 and you're going to divide by 12. That's going to give you monthly. Excellent. Now, why 52? Because there's 52.
Because there are 52 weeks in a year.
Excellent. What about bi-weekly? Come on, yeah, you can do it, guys.
Times 26.
Time 26, yeah.
Excellent. And divide by 12. By 26?
Because there are 26 by weeks in a year.
Excellent. What about semi-monthly?
Semi-monthly, it means twice a month. So,
Yeah, you could do it 2 times. You could do semi-monthly multiplied by 2, or you could do
times 24.
multiplied by 22, divide by 12.
It's 24.
Yeah, sorry. I just lost 2 weeks. Excellent, good job. Okay, monthly is very easy. Monthly already gave you the monthly figure. Easy?
Yes.
You have to take a look at 2 pay stubs in order to identify if they get paid weekly, bi-weekly, semi-monthly, monthly. Okay? 2 pay stubs. Now, if you see on a pay stub overtime, you gotta take a look at last 2 pay stub of the year, previous 2 years. If you see commission, overtime, and any other income, same thing. Last 2 years. Other than that, this is your formula. So we're gonna say, okay, the client, if the client made 150,000 and they got paid monthly, they would have been 12,500 per month. If they were getting paid semi-monthly, it will be 6,250. If they get paid bi-weekly, it's $5,769.23. And if they get paid weekly, it's $2,884.61. Now, you know your expenses. Let's say 9,008. Well, let's just say that we're going to take out car lease and the credit card, and we're going to say the student loan 3,000. Now, her expenses is 6548.20, right? You with me so far? Did I lose anybody? Okay, so we got 6548.20, and we're going to divide that into 12,500. Comes out to 52%. It's still high. Right? So what do we need to do? We're gonna ask, can she convert her student loan, because it's deferred, can she convert to payment plan? A lot of times student loans deferred, they could switch to payment plan based on the income payment plan. And a lot of times it's much lower than we pick it up as 1%. Or we're gonna say, is there any other program that takes only 0.5% instead of 1%? And the answer is yes. Fannie will always pick up 1%. Portfolio will always pick up 1%. But Sonny Ma, Freddie Mac will pick up 0.5%. So we're gonna see if they qualify with Freddie Mac. So we're gonna say, okay, our housing debt is 3548. Now, if we do 0.5%, it's 1,500. Now, instead of having 65, no, I didn't do it correctly, but let's see. Oh, yeah, 5,048. So now, 5,048 divided into 12,500. Now her debt income ratio is 40%. Now she qualified to buy their house. As long as she qualified the LP, which is Freddie Mac, which a lot of times LP is a little bit more flexible than GU. Or Sonny Ma. If it's Sonny Ma, she's a first-time buyer. For two people, from 1 to 2 people, the income in 5 borough New York is 150,000. If it's 3 people, it's close to 180. So it's awesome program. They do look a little bit different than Freddie and Fannie, and the qualification purpose a little bit better. Some easier, some not. But if they qualify, the interest rate is much lower than Fannie and Freddie. But let's say if they're not first-time buyer, we could still switch it from 3,000 to 1,500 on the Freddie Mac. Let's do some more other examples. Let's say you buy a condo. What's a usual 1-bedroom condo in Forest Hill?
Let's say 500,000.
500,000. And let's say a person's still gonna put down 100,000. You're gonna take 400,000. Again, at 6%. Now, help me out. How much will be, so that's gonna be 2398. 20. HOA on a condo, probably like 650. Right? HOA will be 650. It's a little bit less than maintenance, right?
Yeah, it should be less than that, but
Okay, let's do 500.
yeah.
How much would be the taxes? $650?
In where, please?
Yeah,
The co-op
on the
center?
condo, not co-op,
I'm not sure.
Let's say $300 a month.
$300. And insurance, let's say $50. Because on a condo, you only need HO6 policy. So let's check the math. We're gonna have HOA 300. I mean, HOA 500. These 300. $3,600 insurance, taxes. And $600 a year for insurance. So your total, so then it's gonna be $850 for other expenses. So far, your total housing debt is $32,4820. Is everybody with me? Did you see how I got to $32,4820? I took your
Yes.
monthly mortgage and interest plus HOA plus taxes plus insurance will be $32,4820. Now we gotta figure out other debt before you go to the income. Collies, $320. What other expense do you see on the credit report? Minimum credit card, let's say $75. And they have, let's just say student loan. Minimum payment is $73, right? So your total debt is $320, hold on 1 second. So $320 plus 75 plus 73, it will be $468. Now we gotta do the income. The regular W-2 income. They get paid semi-monthly, $69.50. How much will be their monthly expense? So you do $69.50 multiplied by, hello? $69.50 semi-monthly. What will be their monthly income? Come on, guys, you can do this. Anybody? Remember how we broke it down? How much do the multiply and divide by each income section? So if you have semi-monthly, how many times a year you get paid? Anybody? Chris?
24.
Okay, multiply by 24, divide by 12. So we're gonna do $69.50 multiplied by 24. It's $166,800 divided by 12. So they're making $13,900. You with me? Then in order to get total debt to income ratio, we're gonna say 32,4820 plus 468. You're gonna get 37,1620. Now, if you use a mortgage calculator, all you have to do is you're gonna put your annual insurance, annual taxes, monthly HOA, and monthly debt. It will automatically edit for you. So you don't have to do a lot of math. So the only math you would need to do is to figure out total other debt, monthly income, and then you're gonna take, so you're gonna get on your mortgage calculator, you're gonna get total monthly debt, 3716, and you're gonna divide that into your monthly income. Which, let's do it together. 371620 divided by 13,900, it's 26.73%. Actually, if you 74. They could buy a co-op, condo. Are they mortgageable for the condo? At 26.74%.
Yes.
Yes. Because the bank could go up to 45%. They're well more qualified. Now, when you qualify a buyer, this is your debt to income ratio, but you also have to take a look at their bank statement that they have 100,000 for down payment, closing costs. For condo, you don't need reserves. Most of the condo, depending on the price you have, but a regular one, you don't need it, especially if you're first-time buyer, you don't need it. If you don't have any other properties, you don't need reserves. However, if, just like Chris had the second home and he's not selling second home, he would need 6 months reserves if he wants to buy a condo. But most of the easy ones, you don't need reserves. So on a condo, usually you need about 4% for closing costs, 4 to 5% if it's in the Queens. So you would need 100,000, let's say 15,000 for closing costs. So you would need 115 to 120,000 because you're going to throw in if you escrow the taxes and insurance. You will not be able to escrow HOA. You pay HOA separately. Now let's do one. So we did the condo, we did the house. Let's do one for the co-op. Now let's stick with $500,000, and we're going to say, okay, maintenance. Now HOA is not going to be there, taxes is not going to be there, but insurance is going to be there. So on co-op, it's usually mortgage plus a maintenance. So on $500,000, we'll say $1,100 maintenance. So now we're looking at 33, 98, 20. And usually condo for $500,000 is 1 bedroom. Co-op for $500,000 is usually junior full or 2 bedroom. Sometimes even 2 bedroom, 2 bathroom, right? And maintenance on a co-op for 2 bedroom range anywhere between 1,000 to 1,500 depending on the building. Now we're gonna say, okay, we got 33.98. We're going to add our other expenses, 468. Now we got 3866.20. Let's get this out. So when you sit down with a client who wants to buy condo or co-op or a house, you would identify what's the best monthly payment versus the best approval. So to do the debt to income ratio, tell me what would be the debt to income ratio. Your total debt is 3866.20 and your total income 13,900. What would be your DTI? Total DTI.
2781,
Okay.
27%.
Okay, let me calculate. Hold on a second. You're quick. So 3866.20 divided into 13,900. It's 2781. Excellent.
Opa.
Now, will they qualify by the board?
Think so.
Usually board wants to be no more than 28 to 30%. You perfectly fit in. Now, for pre-approval, this is your debt to income ratio. Let's take a look at the assets. If on the bank statement have a large deposits, which usually for the bank, large deposit is 50% more than your monthly income. So if your monthly income is 13,900, 50% of it we're not going to source, unless it's repeating every single week. If it's higher, we need to know where money came from. Now, gift is allowed only from family member. Now, what consider family member? Does a girlfriend consider family member?
No.
No. Is fiance considered a family?
I'm gonna say no.
Anybody else? Fiance considered family. As long as you could prove she's a fiance or he's a fiance. Now, how do you prove? So
The Rock.
we even had to show the ring was bought, the party was paid. So it's not just you're gonna put fiance and that's it. Huh?
Okay, I have a question for you.
Go ahead.
So this client, he sells the asset, overseas in the country, and they want to bring the money to buy a property. What's the best way?
You have to show that it's the asset was on their name. The bank, the deposit is on their name,
It has to be over there in their name and transferred to them.
transferred to their name.
It doesn't matter how much, the amount,
We have no limit,
no limit.
as long as the country doesn't have a limit.
What if it was held by a corporation over there?
Is a corporation under their name? Yeah, if it's their name and you could prove it, not a problem. A lot of times we just do like a gift from the family members overseas. But then again, that family member should have the money.
It doesn't matter the amount. That's what I'm talking about.
We don't have a limit as far as, okay, if you have to source it, right? And then you don't worry about any issues down the line, the rule, the tax purposes, 19,000, if anybody gives you to anybody, $19,000 is not taxable to the person who gives and to the person who receives. But for the bank purposes, right? We're not IRS. So we don't give you the limit. We tell you, you worry about the IRS yourself. You just get as a proof where money came from. And they have to be, let's say a corporation is under your name, we don't have to source anything else as long as it's under your name. If it comes not under your name, we need to make sure it's a family.
How long does it, sometimes the bank will ask you to source funds, but how far back do they look? If you have something that you got 4 months ago,
Yeah, we usually look 2 months.
2 months, that's it.
That's it, unless, so here's a little bit tricky, right? We look at 2 months, but then you move the money from one to another and it has a gap. So and you move the money more than 2 months as a gap because that bank statement cuts off different than this bank statement. Sometimes we have to look further. So 4 months is usually a good cushion. 4 to 6 months is usually a good cushion.
No, what if it's cash? How do you explain?
Cash, we do not like the cash at all. More than 50% of your income, that money will not be calculated as your available funds. We have to back out the cash
So then,
completely.
so what do you do then?
You screwed.
You screw there.
You
You can't do it.
You cannot. I had a client where they had enough funds for down payment, closing costs, and reserve. And then they decided to put $50,000 cash and put more down. And we said, no. We cannot use the cash because cash is not sourceable. So they have to take original loan. We backed out the 50,000 and they could put, let's say, for example, the cash was clean money. We don't believe in cash. So close without the cash, and then you could pay down the loan and recast the loan. But please, very, very important, for most of regular bank, cash is not king.
No, but if the money, the cash was needed to put towards the down payment.
Have them put it in. Way before,
How long is waiting for?
4 to 5 months.
So it has to be already back up.
Yeah.
And what you were saying about,
Gift.
what you were
Okay.
saying about switching accounts, so let's say they put it into my savings account and they move it over to my checkings account.
We will,
That's
we
what
will
you're
check,
talking about?
yeah, we will check. Every movement of the funds have to be backtracked.
Right.
Where the money came from. There's a lot of ways to bake a cake, right? And you as a real estate agent, when you sit down with a client and you see this short of funds, you gotta ask them, where's the balance of funds will come from? Because you don't want the balance of the funds comes at the last minute if it's not so. You understand, guys? Very, very, very important. Not just as important as this, money is important. Now, bank is very sensitive where money comes from. Why? It's because couple reasons. Launder your money. They will make sure the money is clean because they don't want to be. They don't want anybody to come back and you said that, hey, how did you approve the loan? Where the money came from? And if they have no answer, they can't sell the loan. So in that case, you just got to make sure you ask the right questions. So I have a client says, oh, don't worry, my parents will give me the gift. Well, in the pre-approval section, we get an email from a parent that's going to give a gift. Now, a lot of times when money comes in, it comes in other than the parents. Then it becomes a problem. If you're going to write down the gift came from a friend, that money will not be usable. And you cannot take that money out to put a new money in as a gift. You understand?
Yeah, now, is there a limit in the gifts?
$19,000 this year. Anybody could give another person a gift. So let's say you as one person, but our client is married couple. So parent, two people, one parent could give $19,000 to a daughter, another parent could give $19,000 to a daughter. So that is 36,000, right? 38,000, right? Then they could do the same thing to the son-in-law.
The same part.
The same part. So one person could give to another person 19,000. So couple could give to another couple. So it's 38, it's $72,000.
Oh, okay.
Okay, without any tax implication to the giver and to the receiver. Now here's a tricker. Parents could give a lot more without being taxed. I think it could be like $1 million, but double check with your CPA because I know for our purposes, parents could give a huge amount without having any implication to their tax returns.
No, what if we need more money, like some other family members, how many gifts can be like in the?
You could give, let's say you put in 20%,
Yes.
right? 100% of down payment and closing costs can come from a gift. Reserve have to be your money. So you have $100,000 down payment, $20,000 closing cost, $120,000 could come as a gift. And in this case, if we do not need reserves, you don't need to have any of your money.
Oh, okay, now it's good. Okay, that's.
You know, so it gets very tricky, right? But if you go for co-op and you get $120,000 gift, co-op my question. Some co-op will be okay with that, but some co-op do not allow gifts at all. So I know that one building, George Washington, they looked at 2 years bank statement to make sure there is no deposit other than a payroll. We don't do that. So when you qualify for co-op, you have to check which building you're taking them and if they allow the gifts and how much.
Okay.
Bank will allow you 100% down payments and 100% closing cost in a regular programs. Sonia Ma said that 3% have to be your money. Only 3%. Everything else could be gifted. You know? Portfolio. Portfolio, I think they only were asking you 5%. Everything else could be gifted as long as that loan to value is 80%. If loan to value is 95%, Fannie Mae said 5% have to come from your money, whether it's down payment, closing cost. They don't care how you break it down, but 5% have to be your funds.
Right.
Other usable assets, sell of business, but you have to document. Sell of jewelry, you have to document. I had a very interesting client. He sold about $35,000 worth of jewelry. We had to get the receipt because he did deposited cash.
I'm so sorry, let me go back. So when you say sell a business, in overseas selling a property is not the same?
You could do that, but again, you have to show the property, the deed of the property were on their name. They sold it. We have to have a contract. We have to have my deposit, and we have to trace all the steps.
Oh, okay.
Absolutely, you can
That
do
can be
that.
done, okay.
Absolutely, and it's clean.
Okay,
It's kosher.
so you give that to the bank as a
Correct.
of where the money's coming from.
Correct. And if it's in foreign language, you have to translate it.
Translate.
You have to be a special company that translates.
Oh, okay, so that's much
Yeah,
better.
yeah, absolutely. You could do that.
So I was thinking maybe that's not possible, you can only do the money as a gift.
No, it's possible. If it's kosher, it's possible.
Okay, good to me.
Absolutely. We had people so we had a person who sold apartment in Moscow, but they couldn't show that the deed was on their name. And they said, oh, but we had a power of attorney to sell to my daughter's behalf. That was very, and the way they brought the money in, they didn't bring the money. Let's say they wired the money under their name. They brought it through somehow to different names. It was hard to bring money from Moscow to United States because of the political reason. We couldn't use that money. So you have to make sure the money transfer ownership from there to on your name to here under your name.
Understood.
Okay. Now, if you sell jewelry, you have to have the bank ask the jewelry before you sold. It have to be appraised, and then you have to show that you sold it. It becomes a little bit trickier if you sell a boat, jewelry, things like that, where there's no really hard evidence that you did sell it, but we do request an evidence,
Proof, okay.
a proof. I don't come across too much of those that sold jewelry or car or, but once in a while they become very creative.
Yeah, it's good to know.
But the easy ones, make sure you have money in the bank. And if you don't have money in the bank, ask where money will come from. I ask, even though we don't require this, let's say you're going to say, oh, I'm going to get a gift. I ask that person to send me email that they're going to give a gift. So in the past, I would source the gift. And my boss said, oh, you go too much above and beyond. If the parents said they're going to give a gift, just take their word for it. So I stopped asking for a bank statement. A lot of times parents don't want to give you a bank statement to show that they have the money to give because they don't want kids to know how much money they have. Now, in that case, how do we source the gift, right? Let's say people give you the money and they said, it's a gift, it's my cousin. If it's Fannie Mae, Freddie Mac, and FHA, copy of clear check, a gift check is enough, sufficient enough to source as a gift that came from that person. So you do the gift letter and copy of the clear check, make sure the gift letter, name, and the check matches, right? Now, I had cases where the check came from a business. Now, at that case, we will ask if the person, let's say my sister, she said, okay, she gave me 25,000 for me and my husband as a gift. We're gonna, and it came from her flower business, right? Then we gotta get proof that she owns a flower business, that she's 100% owner of the flower business, and then a copy of a clear check. So that relationship matches to the company, then we are okay. But let's say she's not owner of the flower business at all, and she gave me a check from a business and said, oh, I'm her cousin, I'm her sister, I'm her mother, I'm a father. If there is no match to the business, that check cannot be used. The money cannot be used as a gift.
Okay.
You got it, right? So you gotta be careful how many switch the hands from a donor to the giver. And a lot of times when people say, oh, don't worry, I'll borrow money from my parents. Borrow money will not work. Right? Borrowing money will not work. It has to be as a gift in order to use, because if you borrow 100,000, guess what happens? 100,000 is a loan and 400,000 is a loan. Now, what's your what is your ratio loan to value? 100%. Cannot have. Have to be as a gift. If it's a true gift, and then it will work. What are the cases? Those are easy. Gift or money in the bank. Now, can you use 401k as your source of down payment? Chris says yes, right?
I would say, yeah, because it's your money invested for your 401k.
Okay. How much can be used as a down payment for 401k?
I'm sorry, say that again?
How much can you use from 401k as a down payment?
Ooh, interesting question. I don't know.
I think that first-time buyers, they are allowed to take out the funds, right?
Without penalty. Anybody allowed to take funds from 401k? But the rule says if you take too early, if you're not 56 years old or 55 and a half, then there's not only you have to pay taxes, you have to pay penalty. So when the people give you a source of funds as a 401k, the first thing you're gonna ask, are you gonna take a loan or you're gonna withdraw? Why is this important?
Because of the penalty.
Penalty plus.
Because a loan can be taken out of your account and then you can pay back. It's your own money.
Loan. How much loan can you take from 401k?
Depends on the amount.
What is the highest you could take from 401k? Anybody?
Take everything?
As a loan? No.
I'm not sure. I think it's 50%.
You can take 50% or
Really?
50,000. So be careful, very, very careful. So I had a
Whichever
client,
is less.
whichever is less. I had a client who had $500,000 in 401k. They were selling their home, but they didn't have enough funds. So they said, oh, don't worry. I will borrow from $500,000, 50%, which is $250,000. It's more than enough for $1 million co-op they wanted to buy. But guess what? 50,000 or 50%, whichever the less. So they could, he could only borrow 50,000 and she could borrow 50,000. You cannot, even though you have a lot of money in 401k, it maxes out the borrowing to 50,000. Now, if you take the loan, is this your debt?
I don't think so, because you'll just get penalized, right?
No, if you take a loan, you don't get penalized.
It's that.
It is a debt for the co-op. It's not a debt for the bank. They say, that's your money. You just put it in an account, you didn't pay taxes, you borrow 50,000, we don't gonna hit you for the debt, but co-op does. And you gotta be so careful. If the both party borrows 50,000 each, and their monthly payment, they don't go by monthly, they go by how much they're gonna pay per payment they receive. So they receive, let's say, semi-monthly, it's 2 times, and they pay $250 per paycheck. So that monthly debt is $500 a month. So you must calculate that debt into your debt to income ratio. Bank will not calculate that as a debt, but co-op will. So you gotta be careful. Now, if you withdraw, now we have some people very creative. They know that if you pull out the money from 401k and you roll it over to another IRA, within 60 days, it's not taxable. So if you know that you're gonna sell your house and you just need a 30-day gap, you could do that trick. You take money out of 401k and you just roll it over to IRA within 60 days. It doesn't trigger the tax or penalty.
But can you take some away?
If you keep it, then you have to pay penalty and taxes if you're less than 55 years. But if you took 100,000 and within 60 days you open up IRA and roll the money over and just use it a very short period of time, then you don't have to pay taxes or penalty. It will not work for co-op, but it will work for the other properties. So it's a lot of ways you could bake a cake as long as you know what you're dealing with. So when you sit down with your clients, lots of questions, lots of documentations, lots of uncomfortable conversations you need to have. If you're not strong enough to have those conversations, keep practicing, because that will save them a lot of time and effort, and you a lot of time and effort, because your time is your money. Any question? Those are easy ones. Again, if you want to rent, no strings attached. You don't need to give me the loan. If you need to rent it by me, let's say if it's a difficult situation, Olga, how would you qualify that? As long as I could see you do the work, don't send me to do the work. I want you to do the work like Maria. She does the work, she sends it over to me. She said, Olga, this is what I see. This is where I see the gray area. What do you think? And we do it together over and over and over again, and she becomes much stronger on the difficult deals. And then she looks so professional to the clients. She puts herself on a high different level. So you have I have an easy email, olga.savelo@citizensbank.com. I'm gonna write it down. I'll also give you my phone number.
We have one last question.
Yes, sir.
This client, he said that 12 years ago, he went bankrupt. Chapter 7. They let him keep his property in his house. And now, obviously, after 12 years, if it's all credit up, he wants to buy a property, second property. Now, he's saying the mortgage is not in the credit anymore. The mortgage from this property that he owns right now, because of the court, somehow they did dismiss that. But he still owns the property, still in the deed. He's still paying the mortgage. Can he buy the second property 3.5%, or he has still have to put 20%?
It depends. Bankruptcy for FH. After 4 years, we forgive you. Right? But if he is paying the mortgage and it will be on his bank statement, we will use it as a debt.
But it's not any credit, it doesn't show
You
it.
see that the thing is not all the debt is on a credit report, but if it is a debt, we will pick it up.
Also, they'll see in the bank statement. So
They will see it on the bank statement or give the bank a bank statement that's done. So the banks are very, very, very sophisticated, right? We have a huge background check. I mean, as a loan officer, we don't do it, but our back office do a lot of background check. So I have one real estate agent, gave me a lot of business. She wanted to buy a co-op. So credit report looked good. Everything looks good. I took the loan, had it in, just to find out she had foreclosure. She cleaned it up for her foreclosure out of report. It didn't show in the credit report, but it picked up on the bank search or whatever they do. And she said, "No, I cleaned it up. How did you guys find out?" They're very sophisticated ways they could find out. But if it's forgiven debt, why would she still pay for it? If it's not forgiven and it's not on the credit report, but it is a debt, it will be picked up against him as a debt.
okay,
If does he live in that house?
yeah. That's
Then the question will be, what will be motivate him to buy another house?
he wants to do an investment, bro.
He wants to buy investment property, you cannot buy with 3.5% down. So let's say he did not bankrupt, right? He has a mortgage, he owns a property, he wants to buy investment property. Cannot do it with 3.5% down.
Oh, in that case, yes, 100%, but in this case, he thinks that because the debt's not in the.
It doesn't matter, even if he didn't have the mortgage. He owns a house and he wants to buy another house. The question will be, are you gonna buy this house to live in? What would be your motivation? If the motivation to rent that house,
Second one.
you have to put 20% down, minimum. Usually 25% to get a better deal. A lot of times people become very creative. They said, oh, no, I'm gonna live in there. The risk. And I always tell people, always look at the risk. Even though 99% people don't get caught, if 1% get caught and you were part of 1%, it's not fun. The minute the bank find out that you bought a house as a prime resident and you rent it, your mortgage is due immediately. That means if you cannot pay it off, the bank have the right to take the property.
How do they find out?
Very easy. You bought a house as a prime resident, and then next month you put on advertising you want to rent the house. Right? Everything now is very, very, everything is on the internet. You're looking for a tenant, is on the internet. You list your house with a real estate agent, is on the internet. I had a client who bought a house for her son for future to live in there. So she paid about $1.8 million. And I told her, I said, you sure you're buying it for prime resident? Because you live like 2 blocks away. She said, yeah. She put it in to rent. It flagged right away. So every property you finance, the bank make sure there's more renters. There is a special program, it flags that it is for rent. And right away, hello, you got it for prime residence, it's a fraud. You're going to get in a lot of, it's not worth it. Find money somewhere else. Borrow money from 401k because banks don't put it in as a debt. cash it out from 401k. If you have IRAs, we do very interesting with IRAs. So you got a job and you don't have enough money in 401ks to borrow, but you have $100,000 in an IRA. You could roll it over to your company, the company you work for, and borrow 50,000.
How about, I do have like money in my stocks.
Stocks are good.
I just sell it
You sell it and use it.
and that goes to my bank.
For pre-approval, you don't even need to sell. For pre-approval, we use 70% of your stock value. Because we give you a little room for, adjustment on the market. But you definitely could use your stocks.
Without selling, just
Without
show you the balance there.
show the balance and use 70%. Stocks, but not crypto.
Oh, crypto?
Banks so far don't like too much of a crypto because we don't have ability to source the crypto yet. It might come down the line later on, but not right now.
Okay, good to know.
But stocks, 100%. Stocks, bonds, gold, all that is usable as long as you could source it.
Okay.
Was it helpful to you guys? Hello? Anybody?
What was it?
I said, was it helpful to you?
It was very helpful. Your class was very interesting. I learned a lot. Thank you so much.
Thank you. Thank you. I appreciate it.
So summarize again, Olga.
Easy debt
The
recovery.
the DTI that the banks are looking for, what range should we qualify our buyers within?
Okay. For the house, keep it at 45%. For co-op, use 28%. If it's higher than 28%, check with the management if it's okay to go above 28%. Again, total debt to income ratio, we looked at your future housing debt plus your current recurring debt will be your total debt, divide into your monthly income. And you convert your monthly income depending on how much, if it's W-2, how often they get paid. If it's weekly, multiply by 52, divide by 12. If it's bi-weekly, multiply by 26, divide by 12. If it's semi-monthly, multiply by 24, divide by 12, or just multiply by 2. Monthly is you already have monthly.
Olga, credit, what range should we look at our buyers to be within?
Fannie Mae just announced that they don't care about your credit score, but the banks still do. Even though Fannie Mae months ago opened up to any credit score, banks are still have minimum credit score. At Citizens Bank, minimum credit score is 620 for the house and the condo. But for co-op, they look at a much higher credit score and they look to make sure there is no derogatory on the credit, meaning no latenesses, no collections, no judgments.
So would you say for co-ops, 700 would be a good base?
700 to 780 would be good. 700, that means you still have some issues on the credit report right now.
Okay, now run through a couple of the categories of debt that we should bring up.
Sure. So the debt on the credit report is very easy. It will be on your summary page, total debt and a monthly obligation. If you see the total debt for credit cards, you're only going to use minimum monthly payment, even though the client might pay a lot more. So when you ask a client, well, you have how much your credit cards you have? Oh, I have $5,000 on credit card. How much you pay? Oh, I pay $350. Well, what is your minimum payment? Only $75. You're only going to pick up $75. So your total debt will be in your summary, but then you gotta ask, do you have child support? Do you have maintenance payment to your other half? Do you have any other monthly obligation other than insurance, food, telephone? So, because those will be come up on your bank statement. Banks are checked to make sure your credit payments, it takes a look at the withdrawal from your bank.
Down payment and reserves, how much are you, like, what's a good window to be in?
Down payment reserves, so for certain programs, we do not need reserves. For co-op, you need minimum 6 months reserve. So you're gonna have down payment. Co-op closing cost is about 4,500 to 5,000. So the way we do it quickly, your down payment, let's say it's 100,000. Your closing cost for the bank is 4,500, 1,500 for your attorney, and 1,500 for co-op fees. So altogether, it's about 7,500 if you don't have to pay transfer tax or flip tax for the seller. So you're gonna have a down payment, $7,500 closing cost, and 6 months reserve of mortgage and maintenance. The bank don't require your reserve, but co-op does. Co-op only wants 6 months reserves for maintenance and the mortgage. They don't care about other expenses to reserve, but 6 months is a minimum. Some co-ops do 12 months. Very rarely I see 24 months.
Olga, what's the right answer when the client asks what comes in the closing costs and how much is
It depends on the property. Co-op closing
for a
costs
house?
for the house, it's you have mortgage tax, and again, it depends where you buy the house. If you buy in a 5-borough New York, your mortgage tax is 1.8% up to $499,000. 500,000 and above is 1.925. Right? So can I take this out? You guys got my information, right? Because that's a great question.
I got it.
That's a very good question. What consider closing costs? So the bank's closing cost, whether it's co-op, condo, or a house, is the same. We're gonna say it's $4,500. Okay? That's a bank fee. Then you have mortgage tax. Now, in a 5-borough New York, is 1.8% of loan amount. If your loan is $499,999, right? If a loan is 500 and above, is 1.925% of a loan amount. You with me? And we're not going to go above $1 million. Like, because $2 million is a higher mortgage tax. If it's a 4-family, it's a higher mortgage tax. Just a regular 1-family, because to make it easier, okay? Then you have title insurance. You pay 2 policies. You pay owner's policy and you pay lender's policy. Owner's policy, you only pay one time for life of you owning the house. Lender's policy, you're gonna pay every time you refinance. Okay? Usually, I would say it's 0.75%. And it's 0.75% of a purchase price, not a loan amount.
Oh, it's different.
Right? It's different. Now, if you buy in Long Island, your mortgage tax is much cheaper. So in Long Island, it's, to make it easier, again, you could look it up, but just for calculation purpose, 1% should cover $500,000 in a book. It's a little bit cheaper than if it's less than $500,000. I think it's got 0.75. However, in Fibro, New York, it's more expensive on mortgage tax, but cheaper on recording and on searches. In Long Island, recording and searches are higher. So if you buy in a Fibro, New York, recording, I would say no more than $1,000. That's even with a little buffer. Searches, $1,000. In Long Island, your recording would be up to 1,500 or more, and searches would be up to 1,500 to 2,000, depending how much searches you have to make. So it's a little bit, it's not fully offset, but the mortgage tax does play a big factor in your closing cost. Now let's take a look what other closing cost takes. If you buy a property for $1 million, you have to pay mansion tax. It doesn't matter which borough you buy. In the state of New York, it's 1%. If you buy co-op, you do not have mortgage tax or a title, but you're still gonna have mansion tax.
So if it's under $1 million,
No mansion tax.
you tell clients it's about, let's say it's average like 4% closing costs. If it's over $1 million,
Yeah.
5%. Is that safe to say?
Yeah.
Because one more point for the mansion tax.
Yeah.
Okay.
But you could run the numbers just to make it easy. If you guys want, I have a great form Excel sheet that has all the closing costs, co-op, condo, 1 to 2 family, and 3 to 4 family.
Yeah, I think that's one of the next, sometime when you do another class, because a lot of.
I will
buyers-
email you the worksheet. You plug it in, it calculates automatically.
Okay,
And it has closing costs for the buyer. And I have a separate, in the same worksheet, I have a closing cost for the seller.
that'd be cool, yeah. Now, let me ask you a question. Appraisal, sort of,
$4,500.
those all go into.
Survey, we don't, it's not a bank fee, it's your fee.
That's not part of the closing cost?
No. Appraisal is, survey, no. If you buy for more than $1 million and you take a mortgage, let's say for more than $1 million, then $4,500 increase, because sometimes they require 2 appraisals. And the higher the purchase price, the higher cost of appraisal.
So let's say the buyer attorney fee is not part of the closing.
No.
cost. Okay.
No. Because listen, if you take an attorney in Manhattan, it's $5,000. 7,500. In Queens, 1,500. Now, we don't know whose attorney you're gonna hire. It's your cost. We're only gonna require to give you bank's fee. Everything else is your responsibility. Part of the bank fee is your lien search. Now, we have a lot of times people ask, well, how much is a lien search? Lien search done by your attorney. We estimate $350. But lien search just went up in January, so it's probably $400. However, if they did the lien search on a co-op and they find some issues and they do need to do more searches, then it will be more costly.
So mostly the costs are from the bank fees.
Yes.
Or mostly fees, so nothing outside there.
On a co-op, there's no other outside.
Okay.
So what's the bank fees? Appraisal. Again, it depends how much it is. Usually it's $650 and more, right? Bank attorney, it's about $1,500. It's not about 15, it is $1,500. Then you have underwriting fee, processing fee. So that's, let's say, $1,300. Then you have, we put in, let's say if it's a lien search, we put that in. If it's title, we don't put it in. I mean, we don't put it in as part of the bank fee. But, so you have appraisal, underwriting fee, bank attorney, credit report. We always check the property in the flood zone. So 4,500 should cover it. More than enough. So when you look at the closing cost, for 4,500, condo 4,500 plus mortgage tax, title insurance, recording fee, title searches. Then we have to add escrows. For co-op, no escrow. We do not escrow even for insurance unless you do SONIMA. SONIMA must escrow for insurance on the co-op. On a condo, always escrow taxes and insurance. Now, you could waive your escrows if you put 20% or more. If you put less than 20%, you cannot waive escrow. Escrows, what's escrow? Escrow is your money put aside to pay for your future expenses as real estate, real estate tax and insurance. A lot of times you get a question, oh, my monthly payment went up. What happened? Your mortgage, if you took 30-year mortgage, your rate and monthly payment for the mortgage never go up. But what will change is your escrow. And once a year, a bank will give you a recap of the escrow. If your insurance went down and your taxes went down, which never happens, the escrow will go down. The bank is not allowed to keep more escrow than they have to. But if those fees are going to go up, your escrow will go up. The bank will give you annual recap, and will tell you, oh, your escrow has no reserve. We have to collect more per month. Or your escrow has too much reserve. We're going to reduce your monthly payment. And that's what escrow does. And that's the only way your monthly payment will change.
Right.
What happens if bank sells you loan?
Nothing.
Nothing. Your mortgage is, you're saying you just have to pay a different bank. They have to, by law, give you 60 days to change the order payment. Any other questions? I hope I didn't bore you.
Okay, yeah, I got a simple question.
Go ahead.
I do an open house and I have a couple of prospect buyers interested in my house. Do you have something to simplify in where I pull up my laptop and they can go onto your application or web, and then they can see if they get pre-approved right there without even me asking all the detailed questions?
Way you don't even need, not that you don't need me. There is I built a spreadsheet called closing costs, right? You put in your purchase price, you put it in your loan amount or down payment. If you put down payment percentage, it will calculate, let's say if it's a house, right? It will calculate all your closing costs. And you're going to calculate and then say, oh, Olga, what's your monthly, what's your current rate? Let's say 6%. It will calculate and you're going to put taxes and insurance, it will calculate your monthly payment. On the bottom of that spreadsheet, it will say, what's a monthly income? You plug in monthly income, it will give you debt to income ratio.
Okay, that's great. So can I email you and get that spreadsheet?
Email me and I'll email you. Now, if I email you from my computer, which is Dell, sometimes the formulas gets crazy when it's emailed to Mac, but we could fix that.
Okay, you got it. I appreciate it. Thank you so much.
I cannot use Google Drive.
Yeah.
Nope.
Okay.
We are very protective in lender side. No Google Drive, no Google documents shared. I could send it to Jennifer, and she could create a Google Drive, but I don't know if it changes the formula. It's easier for me to email to you, and then me and you will get on the phone, see if the formula works. If it works, it's golden. It takes you like this to check it out.
That'll be perfect. Thank you.
And it's good. It has difference in one sheet. It has all the fields for the, one sheet could be, so one file has multiple sheets. It has co-op, it has a condo, it has a condo resale and condo new build. Now, when it's a condo new build, most of the builders put extra cost to the buyer. Transfer tax, their attorney fee. So if it's a new condo, you have a separate spreadsheet. House, 1 to 2 family, is different spreadsheet than 3 to 4 family. And it's a great file. Also, it has, if you want, I could break it down to 2. One seller file and one buyer file. How many of you does a lot of listings?
I'm sorry, say that again?
How many of you do a lot of listings?
Well, I'm gonna be doing a lot of listings of 2026. So yeah, I'm gonna be representing the sellers.
You got it, because then there's another file I have where if you sit down with your seller and you're gonna say, oh, Mr. Seller, you wanna sell it for $1.5 million? Let's see how much you're gonna net out. That spreadsheet is awesome because all you need to put down a purchase price, if they have a mortgage, and how much are they negotiated to pay you, and it will give them net proceed.
Can we have
Oh,
a
that's
class
perfect.
with spreadsheets?
Absolutely.
Yeah, we should, yeah.
I'll bring my personal laptop because I cannot use business laptop, and I could email to you, and we could work together. If you do 1, 2, 3, listen, this is my way of giving back. I was always promised, Vincent, I've been in this office for 20 years. In 2024, in November, I got adopted 20 years ago. So I always look for ways to give back. And me training you, I used to do training almost every week. And we trained one of the best agents in the industry. Not only me training, but other people training. And if I could give you a tool that you could use without reaching to anybody, it will make you a very successful real estate agent. I
Thank
would
you so much,
appreciate
Olga.
it, but it's not about the business. It's about me giving you back. And that's why I'm willing to share. There's a lot of worksheet I've done throughout the years in my career. So I have another one that says, if it pays to wait. This is really awesome worksheet. You plug in what is your purchase price right now, and then you say, okay, what if the interest rate will go down by 2%? How does it change your buying power? What if it goes down, but price goes up? What is your break even? So those are very sophisticated. Let's start with easy ones. Let's start with as a buyer and as a seller. And then you get comfortable, then I'll send you another one.
Sounds like a plan.
You know, because as a real estate agent, you need to reach out to your past clients at least 8 times a year, right? Couple of times you're gonna say, oh, happy birthday, happy anniversary, happy holiday. Another time you're gonna reach out and say, hey, listen, rates went down. You bought it in 2023. At 2023 or 2024, rates were much higher. Let's see if it pays for you to refinance. So you have to be a higher agent than anybody else in order for your people to constantly refer you, because it's not one transaction.
I agree.
Great information, Olga.
To the class, I'm available up to February 9th. And I'll give you a schedule some.
Yeah, we'll get it on the schedule.
And if you guys send me email with your email address and what you want me to send, I'll send you, because I have, so what do I have? I have already pre-typed the step-by-step process of buying a house. It's the same, I have a separate step-by-step process buying co-op. Because then you could get educated. I mean, I have a lot of trainings that I've done throughout the years. I don't wanna give you everything at once, but definitely I could give you the closing costs and DTI that you could work on your open houses. I know that Michelle used it, Lily used a different version of it, but very, very similar. And it really works. And it takes away the guessing game.
Thank you, Olga.
Thank you.
Thank you so much, Olga. Great information. Thank you.
Thank you,
Yes.
Olga. Really appreciate it.
Absolutely.
Thank you, Olga, and I sent you a text of my